you had a negative real return. Most importantly is price. I think a lot of investors make the mistake of thinking, I want to buy good things. That's a great company. But a great company that gets expensive is much worse than a bad company that's really cheap. Right. So you have to look at pricing. This is all part of the cycle. Everybody says that's great and it's going to be great for the future. And like the internet and .com, it's great, okay, but the price has to be paid attention to. And I'm particularly concerned of those companies at a time when we are in a situation with the interest rates operating as we are. In other words, this looks quite like 1998 or 99, where the assets of the new hot thing are hot, the prices are high, and you have a rising interest rate environment. That is a classic issue. So we have to pay attention to the interest rates and the pricing of those assets, and you have to think where is next. Credit is like blood that brings nutrients to all of the parts of the body, and it passes through a system that is like arteries, and then credit creates debt. And the key question, if it's healthy, is does the debt create an income that is more than enough to service the debt? And that's like, I don't know, eating vegetables or something. It's a healthy process. And if not, credit begins to build up this debt. It begins to become like plaque in the arteries. And you can measure it, just like you could measure it in the arteries. And you can see how it constricts that circulatory system, because as credit and debt service rise, you see that it eats up more and more consumption because you have to spend that. So you could watch the government do that. You can see that how interest is eating up and debt service is eating up, and that means there's less money. And then you also can see how heart attacks take place. And they're very, economic debt heart attacks. And the way they take place is by looking at the supply and the demand. If you have a lot of debt and then you have a large supply of debt, that has to be bought. Somebody's got to buy it. And so when you get to the point where there's debt risks, there's not only the new supply that has to be offered, but there is the possibility of holders of those debt assets selling those debt assets. And so the supply becomes overwhelming relative to the demand. And then it's the same dynamic for the government as it is for an individual or a company, except the government can print money. So when that debt service burden rise, or there's a big supply-demand imbalance, if the government, most importantly the central bank, doesn't print money and buy it, then there has to be a rise in the price of the debt to constrict borrowing. And that borrowing constricted, that credit that is not going to come, will weaken the economy and cause bad economic conditions. And so they can let that happen, or they can print money and buy the debt and monetize it. When they do that, that's inflationary, and it lowers the value of the debt. In either case, you don't want to hold that debt, because either there's a debt service problem or there's a depreciation. You get paid back with a greater supply and cheaper money. And that is the dynamics, and that's the mechanism. And because it can be measured, it can be seen in all countries, you can watch it happen. And so like you're going to your doctor, you can measure these things, you can see them, and you can know what needs to be done. There were two waves. The first wave was the COVID wave, in which they put out, the government wanted to, and actually did, deliver a lot more money to people, companies, then there was a loss of income. So they, first wave, a lot of that money. Where did they get the money from? They had to borrow it. The central bank then came in and lent them. That was the primary. Then the second, when President Biden was elected, there was a second wave of that after COVID. It was mostly like a universal basic income thing. In other words, hand people money and we're going to be better off. And so they handed people money, doing that same exercise again. And so naturally, all these people got a lot of money, And so they deposited them in banks, they went out and spent, and so on. And it therefore shouldn't be surprising that we had a big wave of inflation. And we also had a lot of banks buy government bonds, which they lost a lot of money on. And that was that crisis. So that's how the mechanics work. You can't get richer by making money. And there are two purposes of money, which is as a medium of exchange and a storehold of wealth. Saving is very important. And if you don't have savers who have it as an effective storehold of wealth, then you don't have a viable long-term credit market. People don't understand that the bonds become a bad deal. You need that, like any marketplace, you need purchasers and sellers to be able to have an efficient negotiation to achieve a balance without the government coming in and printing a lot of money and make a big mess. It's like they made very severe negative real rates. And we know what happened with the severe negative real rates. And the government, while they were making the significant real rates, it was the government that was the big buyer. Okay, yes. So the government takes it on and they make negative rates. So what happens is then you get everybody leveraging up. Then you've got a problem. And it's a global issue. It's not just an American issue. First, when there's a lot of borrowing to service debt, there's what's called death spiral. We typically refer to that when a company has it, the government can have it too. And that is that dynamic where there's too much debt and you have to borrow to service the debt. People, investors know that that's a problem to service the debt, so the credit is worse. And that means that interest rates go up, which is the worst thing that can happen to a heavily indebted entity. And then as they rise, you get that spiral, you need to borrow more, and so on. So that is also noticed when then there is the key spot is when the debt service becomes large. And then like the real red flag, the biggest red flag is when there's then the selling of the debt beyond the new supply, but the holders of it sell it. And then you can see it in the market action because you can see that long-term interest rates rise while short-term interest rates aren't rising or go down. So it's the free market losing its desire. You have a balance problem in the free market out there. And then you start to see that when the currency then depreciates, particularly relative to gold or Bitcoin or other assets, and sometimes other currencies. But typically, these things happen, broadly speaking, together, in which all currencies go down relative to other things like gold, Bitcoin, or tangible values. And so that's what it looks like. That's that edge. Then you start to see the dynamic. So you either see the central bank comes in very quickly and does the buying. And when that happens, you see then the currency. To take Japan, for example, if you were a holder of Japanese bonds, you lost about 80% of your money relative to gold and about 60% relative to U.S. bonds because you received an interest rate that was 3% less than the corresponding interest rate in the United States. So you lost the interest rate. And interest rates in the United States, as you know, were very low relative to inflation for most of that time. Plus, you had a depreciation in the currency. So you lost a ton of money in the debt that way because the central bank came in and printed the money. It's very bad for holders of the debt. Right. And it's a basic thing. You don't have to even get too technical. It's just a supply-demand thing, While gold has gone up and Bitcoin has gone up. So that is that kind of market action I'm talking about. And you've seen it in other countries too. The UK, very classic. The dollar has been a relatively strong currency, but not measured in gold or Bitcoin. So all currencies have gone down. And then you've had that dynamic you're talking about. And you see it also in, like sterling is a good example. Sterling has gone down while UK bond rates have gone up and central banks have held it steady. And so you see it in the market action. You also see it in terms of who the buyers are. You've seen central banks, for example, and sovereign wealth funds shift to have lesser amounts of debt, bonds, and so on, at the same time as they've accumulated gold or hard values. Gold is the third largest reserve currency, by the way. Dollars, euros, gold, and then yen. So, yeah, you're seeing that supply-demand shift. And it's partially for all the reasons we're talking about, and also partially because of issues like geopolitical issues. Countries sometimes worry about sanctions. China is worried about holding bonds. You would, U.S. bonds. Japanese bought a lot of bonds. Even as a percentage of portfolios, the bonds themselves have become such a large, U.S. Treasury bonds and U.S. debt has become such a large part of the portfolio that it's even from a portfolio rebalancing point of view, you don't want so much concentration. All of those factors are in play for the supply, demand, and bonds. That's why I emphasize you have to look at the supply and demand of bonds. The United States and countries like China, you see that particular dynamic. China, Japan, they're all educational, and that means that the bonds, the debt, are bad assets. So then where you store it is in those assets that benefit rather than suffer from the reduced value of money and the buying of it. And obviously, you look at money and what is an international money. That is why gold is in it. And then there's a question of, Bitcoin or others are a conversation. We can digress into that. But it can be, ideally, it's international, it's mobile. Ideally, it's relatively private. So it's relatively secure because in history, there's the value part of it, and then there's the confiscation part of it too, in some fashion or another. That confiscation can easily take the form of taxing on holding it.
Right.
For example, one of the problems with real estate, besides the fact that it doesn't move, so it's not internationally, you can't use it internationally, is it is a readily taxable asset. It's there.
It's there.
And therefore they won't take it and you can get it. So we have to understand that taxes and confiscations are one and the same. It's so interesting. I've studied history, and of course I've been through a bunch of these, like the 70s. Commodities, ideally also those that might do well if the economy doesn't do well, because you're dealing also with the inflation environment, are always gone to. You don't want economically sensitive commodities as much, unless sometimes maybe the economy will do pretty well, but usually it doesn't. Like in the Weimar Republic, give an example, rocks were used as storehold wealth. Now, that sounds really funny, but they were considered building ingredients. In other words, the rocks were used to build things with, and so they would store the money in rocks. But any asset, it is those things that can't be devalued. Commodities, by the way, in real terms, all commodities, every single commodity, in real terms over long periods of time have declined because of productivity. Every commodity has declined in real terms because of productivity. So you would like productivity producing assets that cannot be taxed, can move around from place to place. So equities of a certain type tend to do that. That's why currency depreciations are associated with that combination of things. Currency depreciation, lowering interest rates, and producing money causes equity assets to go up, not necessarily in real terms, like in the 70s. They didn't go up in real terms, they went down in real terms. But it is those kinds of storeholds of wealth that can't be taxed as easily, that benefit from inflation rather than not. The purest play is gold because gold can be transferred between countries. It's used by central banks as a reserve, so central banks will go to it. They are going to it. Right. They'll hold it. It can be private, more so than crypto. Crypto is very easily taxed. In other words, the government knows where it is and who's doing what and so on. And it's also an effective asset to tax, but it has, benefits too. It was very interesting when we had negative rates. I was with a group of the central bankers in a discussion of how negative they can have rates. And they described that they can have negative rates only to the extent that there's not enough capacity for paper money to be stored. So they estimated, it was funny actually, that they could have over a short period of time up to 400 basis points negative rates.
That's crazy.
Because there wasn't enough, they calculated how much vault storage space there was. And then they calculated that they would produce more vault storage space because it would be profitable to do that. And they said, and the good thing is we can tax it. Because if you have a digital currency, you can tax it.
Do you own Bitcoin, Ray?
Yeah, I have some, not nearly as much as gold. It's kind of my diversifier. I try to find I have to have some, but I'm a gold guy much more than I am I think that the tech war, certainly productivity, I'm with you, man, but you want to invest in productivity. But there's disruption, great disruption that's going to take place. And there are going to be the disruptors and the disruptees. And it's not necessarily those who are producing the vehicles, but it's those who are implementing and changing as a result of having their big impact. I think that like the tech war for the AI war easily is, I think it is actually more important. It's a war that no country can lose because it's more important than profits. If you lose, if China or the US really lose this war, it's more important than profits. And so you have to play that war that way. And it could be like electric vehicles or more in terms of Chinese electric vehicles and the like, you can produce them. So I don't think, and I think there's such expectations. I think we are going to see applications. Like I think the Chinese are a bit behind in the chips, but they're ahead in the applications. And so I think you're going to even see, the Chinese play is going to be chips, very inexpensive chips embedded into manufactured goods. Totally. You'll see robotics. So you're going to see Chinese are unbelievably in making things inexpensively, terrifically. They own 33% of all world manufactured goods, which is more than the combined US, German, and Japanese manufactured goods. Chinese produce more. So, you're going to see that type of competition. And it's like solar panels or something. Its profit doesn't matter. So you have to go where there's productivity and innovation and disruptors to be essentially long those who are benefiting themselves through usage or creating the applications that are having the big effect is certainly one thing. But you also have to look at different countries and places and things. I think diversification is very, very important because everybody's leveraged long. Everybody thinks, I'm going to buy assets that are going to go up. And if they're good, I'm going to do that in a leverage way. So the world is so leveraged long. You have to pay at least as much attention to correlation. So that's why when I look at, something like gold or these uncorrelated assets, it's interesting. As you add it into the portfolio, it reduces the risk of the portfolio. So you have to pay attention to the uncorrelated assets in that kind of an environment. And those could be geographically looked at. So that's part of portfolio construction. Equity prices, just to keep in mind, many times equity prices in inflation adjusted, therefore purchasing power terms, have declined 60 or 70%. From 1966 until 1984, you had a negative real return. You have to look at your returns in real dollars. What can you buy? It's funny because I watch the value go up and down, even the currency go up and down, and it's a distorted perspective. It's like being on a boat that's going up and down and judging the land to be volatile. Just to be clear, 100% does not mean 100% probability of it happening. It means 100% that's the highest that it's ever been. Just to describe it, the longer-term risk gauge is taking existing amounts, projecting those two things that I've described before, the supply, demand, and the debt service creating the squeeze. So think of it as going into your doctor and having him give you your test results and how much plaque is in there and what it's looking like and how you did on your stress test and what your arteries are looking like and what your condition is. That's what the first measure is. The second is you're in a seizure. In other words, now, so that second measure of the debt is exhibiting, okay, it's now happening. And happening means things like you're seeing the selling, you're seeing the spreads widen. In other words, the interest rates rising on the long end without the short end. You're seeing that the central bank is put into that position of being able, having to make the difficult choice of coming in there and monetizing everything very much, and then credit problems and debt monetization, because you're in the middle of it. That's what the one on the right means. So what we have is, if I'm speaking to you as the government policymakers, your condition is very bad. You're not in the middle of it now. In other words, we're not seeing that particular dynamic transpire, but you have to change your diet. You have to change your behavior. You have to maybe have a stent put into the equivalent. So you asked about what that is, okay? Like that chart, if you go back to that chart, think about that chart as being, your plaque, so to speak, in the arteries and the debt service. So you could calculate all those numbers and you know what the picture looks like. And that is a stability. So number one is, I call it my 3% solution. The solution is you must cut the deficit, which is the equivalent of bonds selling, down to 3% of GDP. And it's 7.5% expected. Now, different people have different views as to how to cut it. Forget it. I don't really care. Just you have to have a unified agreement. Everybody in Congress and the president and so on should pledge to do that. And then the question is how to do it. But they should know that number. It sounds draconian, but we did that kind of change from 1991 till 1997. And there are three keys to this. Do it soon, fast, when the time is good, when the economy's good. In other words, do it now. The temptation is going to say, well, we're going to ease into this and we're going to be there and we're going to do it in 3 years from now. But if you have a bad economy, you cannot do it. That's the worst. So we have the best economy, and the sooner you do it, the more you're going to do it. So 3% solution, do it now, and recognize that you have to deliver it. So if you're having, let's say, cost cuts in government, you have to own the number. So everybody's got to pledge 3%. Now, there'll be arguments as to how to get there, but you have to own the number, so much so that you'd say, if it's not 3%, throw me out of office because I've got to deliver that number. So if government cost expense cutting, is it really the 2 trillion number? Is it the 1 trillion number? Is it a half a trillion number? Right. We all throw those numbers around. You got to own the number and you got to get to 3. And you can't make it any one thing. But you also have to realize, like if you did it spread out, nothing's going to be that big. So, nothing's going to be insurmountable. So the important thing is 3%. The other thing about it is to realize that if you make those moves, the bond market will benefit. You see, and so interest
rates will go down.
Right. And interest rates going down, interest rate expense is most important.